Hello and welcome to the BDO Budget 2018 webinar. My name is Ashley Hill. I'm joined by my colleague Malcolm Pengelly, and we're going to be talking through the changes which were announced in yesterday's budget. I'm going to be covering off the personal taxes and the employment taxes, and Malcolm's then going to be moving on to the business taxes, indirect taxes, enforcement and HMRC powers. So, with the final stages of Brexit negotiations fast approaching, it was not clear whether Mr Hammond would use the budget to make any significant announcements, either politically or economically. He was under some pressure to instill confidence and to back up spending promises already made, particularly in respect of NHS spending. Encouraged by increased tax receipts and improved economic forecasts, the Chancellor made a number of announcements that perhaps demonstrated a loosening of the purse strings. He delivered the positive message that austerity is ending as a result of the hard work of the British people and the government's balanced approach to public finances. However, he did warn that fiscal discipline will need to continue. So the Chancellor announced a number of tax changes and consultations. Tax savings for businesses are focused towards investment in innovation. For individuals, the promised increases in personal allowances and the higher rate threshold will take effect 1 year than planned. And moving on to the personal tax changes which were announced. As I mentioned, the main change in terms of loosening the purse strings was the increase of the personal allowance to £12,500. Now, this will be introduced from 2019-20, i.e. next 6th of April, as opposed to the following year. So he's brought this forward. And what this means is that effectively an individual can earn up to £50,000 worth of income before they become a higher rate taxpayer. The continued abatement of the personal allowance is still in place. So, as you know, once you earn over £100,000, that personal allowance will be clawed back. That continues. Jump on a couple of slides here and then back. So this is an example, a table here which shows the impact of withdrawing profit from your company in light of those changes to the tax bands. As you can see, for 2021, the effective rates are coming down. Jumping back a slide, there were announcements around property issues. It was believed that the rent-a-room relief of £7,500 would be changed to make it harder to claim that relief, and the need to be a shared occupancy test to ensure it's better targeted for the right type of person claiming the relief. However, this didn't go through, and it's kept as it is. Other property changes, which Malcolm's going to cover in a bit more detail later on, is consultation on the further SDLT surcharge for residential property bought by non-UK residents. So will there be a further 1% on top of the already high SDLT rates for non-residents buying property? We'll wait and see what that consultation brings. And also, the government will extend first-time buyers relief in England and Northern Ireland, so that all qualifying shared ownership property purchases can benefit for the relevant transactions. Also, from April 2019, non-UK residents are liable to UK capital gains tax on the disposal of direct or indirect interest in all UK property. This is quite a fundamental change, because currently and prior to April 2019, it's only UK residential property which is caught to capital gains tax for non-UK residents. Now the change is that all property, including commercial, is going to be caught from 6th of April 2019 with the same sort of rebasing provisions as we had for residential property, for commercial property. But also the other fundamental change is that also it's being aimed at the sale of shares in companies as opposed to just the sale of direct interest in properties. So property companies' sale of those shares will also be brought into the provisions. say the last bullet point there, all non-UK residents must report disposals of UK residential property and pay tax due within 30 days, unless they are within a self-assessment system, which means filing and paying the tax in line with normal self-assessment deadlines. A couple of other changes here, which are not on the slides, on this slide anyhow, is the change to principal private residence relief. The main change being around the deemed period of occupation, qualifying occupation, which is being slowly reduced. It's now, well, currently it's 18 months, and the proposal with effect from 6th of April 2020 is that it will be reduced to the last 9 months of ownership. So if the changes come in as planned, individuals buying a new home before selling their old one will need to ensure a sale of the old property takes place within 9 months to avoid a potential capital gains tax charge. The other change to the principal private residence relief legislation is around lettings relief. So currently there's a £40,000 exemption on any gain for letting relief. From 6th of April 2020, lettings relief will only apply in situations where the owner of the property is in shared occupancy with the tenant. I'm not sure, I don't come across too many examples of this myself, so it looks like it might be quite difficult to claim letting relief going forward, unless the individual selling the property lived in the home at the time it was let out. And moving on, this slide is headed to self-employed changes, but also covers some important changes to entrepreneurs owning shares and entrepreneurs relief. So looking at the self-employed changes, Class 2 NIC to be retained indefinitely. The Class 4 NIC upper profits limit to be extended to £50,000 from 6th of April 2019. I should probably point out, actually, also going back to one of my earlier slides, whereby the threshold for income tax becoming a higher rate taxpayer moves to £50,000. This also is the threshold for NIC as well. So the result being, one of the ways, I guess, the Chancellor is thinking of funding these giveaways is that he'll be collecting more NIC. So the flip side to the coin there. Next point here on the slide, off-payroll workers, rules to be extended to large and medium businesses from April 2020. I cover this off in a little bit more detail in one of my later slides, but really this is around the IR provisions which were brought in to combat IR35. Now, several years ago, there were provisions for the private sector whereby private sector payers the obligation to report under IR35 and withhold PAYE was changed to be on the payer as opposed to the payee. The change now to these rules is that it's going to apply to all large and medium businesses, i.e. the public sector as well, bringing it in line with the previous changes. Next point here is making tax digital for VAT to go ahead for most businesses from April 2019. Malcolm is going to cover this off in a little bit more detail in one of his slides later on. So as I said, yeah, there's a big change to entrepreneurs relief, which will impact our clients. I mean, it was mooted perhaps in the budget that the rate of capital gains tax would increase as opposed to staying at 20%. This hasn't happened, fortunately. Of course, there's the question where we are with the budget, the BREXIT negotiations. If a no deal actually transpires, the likelihood is that there will be another budget in the spring, and depending on the outcome for the economy, the Chancellor could need to look to ways to raise taxes, and obviously increasing capital gains tax is one of those ways, because there's a big differential at the moment between the capital gains tax rate of 20% for most assets, and the highest rate of income tax of 45%. Anyhow, from the main changes to entrepreneurs relief, from 29th of October 2018, i.e. budget day, the claimants must have a 5% interest in both the distributable profit and the net assets of the company. So this is a change whereby previously it was only necessary for the taxpayer to have 5% of the ordinary share capital and votes. Now it's extended to 5% of distributable profit, i.e. dividends, and 5% of assets available on a winding up of the company. This means that qualifying for entrepreneurs relief, an individual must have 5% of the economic interest in the company. These additional tests have been brought in to address an anomaly whereby individuals could previously hold 5% of the votes and nominal value of the company but not have commensurate economic interest. So the change affects the eligibility for entrepreneurs relief of those who hold shares that have voting rights that are disproportionate to their entitlement to economic benefits in the company. The other change for entrepreneurs relief is around the holding period of assets to claim the relief. So currently there's a 1-year ownership period. This is going to be extended to 2 years ownership period. So you need to hold the assets, i.e. the shares or the business, for 2 years before entrepreneurs relief can apply. And this change is coming in from 6th of April 2019. The change will apply to basically disposals made on or after 6th of April 2019. Individuals who hold or held their shares for more than 1 year but less than 2 years at the date of disposal will not be eligible for entrepreneurs relief. This is an important point for your clients. If they're going to be selling their businesses or shares, etc., after 6th of April 2019, there's a question mark over how long they've held those assets for and the need to hold them for 2 years to qualify for entrepreneurs relief. It may just trigger some clients thinking of disposing of their assets before 6th of April 2019 and the change comes in. As I said, there have been speculation that more radical changes are being contemplated, such as abolishing ER altogether. However, the Chancellor strongly reiterated his commitment to entrepreneurs relief as an important means of supporting entrepreneurial activity in the UK and as a long-term business investment. This slide that you can see on the screen, it just goes through the different allowances, ISAs, etc., and annual CCT exemptions, seeing the changes from 2018-19, 2019-20, and some of the other EIS, SEIS, DCT release, etc. You'll see pension annual allowances stayed the same, IHT nil rate band stayed the same. The IHT main residence nil rate band has increased slightly. I'll move on, won't dwell on this slide any longer. EIS, there's some new rules introduced for knowledge-intensive company status. And you see the conditions here. Higher investment limits from 6th of April 2020. At least 8% of the funds raised must be invested in knowledge-intensive companies. The time within which approved funds must make their investments will be extended from 1 year to 2 years. Funds will be required to invest at least 50% of each raise within the first 12 months, and to keep that money is not yet invested in cash. And investors will be able to carry back their relief against income tax liabilities in the year before the fund closes. So moving on to employment taxes. So one of the main changes here is around the clampdown on disguised employees. So it's all about off-payroll rules are extended to the private sector. So to help taxpayers comply with the existing rules and bring the private sector organisations in line with public sector bodies, the government will reform the off-payroll working rules. So in April 17, there was a change whereby public sector bodies engaging workers through personal service companies had a responsibility for establishing whether IR35 applied to the engagement from the worker and their personal service company to their engager. So the emphasis was put on the engager complying with IR35 as opposed to the worker or his personal service company. It brought about a requirement to deduct pay as you earn from the payments it makes to the personal service company and pay employers NIC on that payment. What the change here is that was only for the public sector. It's now being brought in line for the private sector as well, who private sector engaging personal service companies. This slide just demonstrates previously the change in the NIC. Upper earnings limit, so from 1920 it's going to over £962 per week. There'll be 2% on that, the upper earnings limit. Other changes from April 19. So there's a piece here around, this has been talked about for a couple of years now, employers' NIC changes on termination payments. This is going to be delayed until 6th of April 2020. So further delays, employers' NIC change on termination payments over £30,000 is now intended that the proposed reform will take effect from 6th of April 2020. The rules were expected to take effect from 6th of April 2019 following previous deferral in November 2017. So it's a welcome surprise for those employers who are looking to implement any large redundancy packages for 6th of April 2019 and will give them further time to plan and implement accordingly. The piece around the apprentice levy, so larger firms who are incurring the levy are able to use some of their funds they pass on to apprenticeships within their wider supply chain, so they can use this to fund supplier firms, related firms and consumer firms. And there's a couple more other minor changes you can read on the screen there around optional remuneration arrangements for cars, relaxation of rules for employees claim relief for travelling expenses. I'll pass over to Malcolm now. He's going to cover business taxes.
Hi, I'm Malcolm Pengelly. I'm going to take you through business taxes and everything else. The headline rate of corporation tax is not going to change for 2019-20. I guess we will be dependent on Brexit as to whether we see 17% from April 2020 onwards. The overall budget for businesses was probably pretty neutral, although there is some good news and some bad news as normal. Perhaps we can start with the good news on capital allowances. There's going to be a substantial increase in the annual investment allowance to £1 million for 2 years, starting from the 1st of January 2019. That will be definitely welcomed by business. They've been asking for it for a number of years. There will need to be transitional rules as we go into the regime in January 2019, where accounting periods don't end on the 31st of December. And again, there will be transitional rules when we come out of the new regime in 2021. There is a new allowance called Structures and Buildings Allowance, modelled on the old Industrial Buildings Allowance, but there are some quirks to it. It's only available for construction of new non-residential structures and buildings, including extensions. They're included as well. The rate is 2% flatline. In other words, it will take 50 years to get relief for 100% of the cost. It is intended to benefit business-type buildings, so offices, retail, wholesale, walls, bridges, tunnels, factories and warehouses are all within the provisions. So it's wider than the old industrial buildings allowance, which is good news. However, although you have to have an interest in land in order to claim, the cost of the land, the legals, the stamp duty, etc., are not themselves eligible for relief. Some changes to the special rates pool. That's currently 8% reducing balance, but from next April, the allowance will reduce to 6%. So that's going to affect things like integral features, air conditioning and the like, thermal insulation, and cars with CO2 emissions over £110,000. Hopefully a lot of those will be covered by the annual investment allowance, so the reduction won't be quite as onerous as it would otherwise be. Enhanced capital allowances are going to come to an end from April 2020. I guess the government considers that we've got about as green as we're going to get as far as the revenue is concerned in subsidising it. So although there will be a technologies update for 1920, which will be issued shortly, that will be the last change to the list of qualifying items for this 100% allowance. Of course, as we have an enhanced annual investment allowance at 100%, a lot of this expenditure will be covered by the increased AIA. So hopefully not too many will lose out. Moving on to research and development. One big change on R&D is that the payable tax credit, which is available to loss-making SMEs, is once again going to be subject to a PAYE and national insurance cap. For those of you with longish memories, you'll remember that this situation also applied a few years ago, albeit the cap was 1 times PAYE and national insurance. The revised cap is going to be 3 times PAYE and NIC. So this is going to impact businesses with small payroll costs. Obviously, if you've got very few staff on your payroll, your PAYE and national insurance is going to be limited, and thenceforth your ability to reclaim the repayable tax credit will also be impacted. So a little bit of thought will be needed going forward as to quite how you structure your R&D teams going forward. Some changes to the intangible fixed asset regime. The Chancellor was very clear in his budget speech that he wanted to increase the investment in UK PLC, hence the improvement to capital allowances, but also he wanted to foster investment in intangibles. The first change is to reinstate amortisation of goodwill, which he removed as a qualifying asset for amortisation relief some time ago. But that will come back in. So we've had a hiatus from July 2015, but from 1st of April 2019, amortisation of goodwill will be back on the agenda. No doubt we'll see the provisions in the Finance Bill when it is made available on the 7th of November. The second change to the intangibles regime has been asked for many, many, many years. What's known as old-style goodwill, in other words, the goodwill which is still dealt with under the old capital gains tax regime, was subject to a degrouping charge if the business and goodwill had been transferred intra-group within 6 years. But for trading entities, if the substantial shareholdings exemption applied, that tax liability which arose on the sale of the subsidiary was itself covered by substantial shareholdings exemption, so wasn't actually taxable. That regime did not apply to intangibles. There will now be changes to the regime so that that gain can be covered by SSE, and that will apply from the 7th of November. One final point on intangible assets is that income from such intangible assets held in low tax jurisdictions is going to be taxed to the extent that it is related to UK sales with effect from 1st of April 2019. There was originally a proposal that would be dealt with by way of withholding tax. That's now gone, and there will be direct assessment on the overseas intangible property holder, although quite how in practice that's going to work, how HMRC will find out who to raise an assessment on, I'm not too sure, but watch this space. No doubt we will see more. For those of you who deal with corporate tax, you'll be getting to grips with the regime for corporate losses from the 1st of April 2017. These didn't cover capital losses, which to date have been offset of these capital losses is unrestricted against current year capital gains. However, a similar regime to the income regime will be in force from the 1st of April 2020, whereby, subject to no restriction applying to the first £5 million of carry-forward losses, anything in excess will only get a 50% offset of brought-forward capital losses. Capital losses will continue to be streamed, so you won't be able to offset your capital losses against your trading income, loan relationship income. It will be ring-fenced. As this comes in from the 1st of April 2020, if your accounting period doesn't end on the 31st of March, you're going to have to split your accounting period into periods pre and post 1st of April 2020 in working out what you can relieve your capital losses against. The definition of permanent establishment is to be amended. This is to prevent fragmentation of activities favoured by large multinationals such that they get various parts of their business carried out by different parts of the group such that no individual entity has a permanent establishment within the UK. As a permanent establishment is the basis of whether or not you pay corporation tax. If you haven't got a permanent establishment, you won't pay corporation tax and you get all the benefits of being out with the UK corporation tax regime. This is going to be countered by the UK revenue looking at all the activities and asking the question, if we look at all the activities, would this amount to a permanent establishment? And if it does, UK taxes will be due. Probably the most widely commented on provision in the Chancellor's budget statement yesterday and overnight are the changes to the digital economy, whereby from April 2020, the UK will unilaterally be imposing a turnover-based 2% tax. As Philip Hammond was keen to point out, this is not a sales-based tax. It's called the Digital Services Tax, and it is related to turnover on digital services such as domain names and advertising and such like. It's only really aimed at the big, large multinational stroke US companies. So it's those with activities of over £500 million per annum. There's a £25 million allowance, so small transactions will fall out of charge to tax. This is not a big money spinner. By 2022, the government's estimate of the tax collected is in the region of £400 million, which is really what we're spending on potholes and repairing bridges. So not a huge money spinner for the UK. Of course, changes to the digital economy are also being looked at by the EU, and by the time we get to 2020, there may well be Europe-wide changes to the taxation of the digital businesses, which might make the whole of this slightly irrelevant. But no doubt we're going to go it alone, and we will seek to take our 2% cut. Quite what President Trump has to say about this, seeing as it's mostly US companies that are going to be involved, no doubt we will find out in due course. Business rates. The Chancellor was very clear in his speech yesterday that he wanted to help the high street, although I think there was an appreciation that the future of the high street is diminishing given the increase in digital activity, particularly here in the UK. So, with a view to helping those that remain, there is going to be a 1/3 reduction in their business rates for those with a rateable value up to £51,000 for the next 2 years. The next round of reviews of rateable values actually will be due immediately thereafter, so we'll see where that gets us then. But for the moment, a helping hand to small retailers. There's also help for local newspapers, and for those people who saw the budget speech yesterday, 100% relief for all public laboratories, which I'm not sure whether that was just an excuse for Philip Hammond to crack a joke, but there you go, it will be of help. There is also going to be an additional £900 million to help businesses, and hopefully it will keep the high street going for a little time yet. HM Revenue and Customs have consulted over the last 12 months or so on the reform to property taxation, and these are going ahead. This is just a reminder of what to look forward to. From the 1st of March 2019, SDLT reporting, which you've all got used to from 2003 as being 30 days, is going to be reduced to 14 days. There'll be, I suspect, a bit of a challenge to get all the information together to prepare the returns and get the cash totted up and sent to HMRC, but that's coming from the 1st of March. In April, non-UK residents will be liable to UK CGT on direct or indirect disposals of UK property. That's all UK property now, not just the residential properties that we've been used to in the past. And indirect interests are effectively taxing the disposal of shares in property-rich companies. And although there's been a carve-out from non-resident CGT for diversely held entities, they will now fall into the UK CGT regime from April for their gains on residential property. From April 2020, non-resident companies at the moment fall outside of the UK corporation tax regime, and therefore they will pay capital gains tax from April 2019 on their disposal of UK land. From April 2020, they will be brought fully within the corporation tax regime and will pay corporation tax, which means an effective rate of 17% corporation tax if we get that far. So something to look forward to for companies. They will need to get used to the corporation tax regime, including being able to deal with the loan relationships and derivatives regimes, which will be completely alien to these businesses. So there is a learning process to go through, but at least you've got a year and a bit to get up to speed. Other corporation tax changes ahead. These are largely going to be of limited interest, but for those that it affects. So changes to the interest restriction, as if we haven't had enough changes to it already. Those accounting for leases under IFRS 16 will see changes to the tax rules broadly to keep the status quo, rather than to make changes to the tax laws directly as a result of a change in accounting IFRS 16. And there will be new substance requirements for companies resident in Jersey, Guernsey, and the Isle of Man, and we'll look forward to seeing that. Moving on to April next year, quarterly payments of corporation tax. The payment regime will be such that payments to the Inland Revenue will be accelerated where annual profits are over 20 million. And there are yet more changes to the corporation tax loss rules that we just about got used to from April 2017. And if we don't have too many hiccups with Brexit, main corporation tax rate will drop to 17%, as I previously mentioned. Indirect taxes. That means VAT. The VAT registration threshold has been £85,000 for quite some time now. It's going to continue at that level at least until the 31st of March 2022, and deregistration limit at £83,000 to the same date. There have certainly been discussions about significantly reducing the VAT threshold, but it seems to be a nettle that the Chancellor doesn't want to grab just yet. The Chancellor is looking at ways of accelerating payments of VAT, not just from the point of view of customs getting it earlier, but also in order that VAT doesn't go missing when it's paid to the supplier of goods and services. So one of these regimes is the split payment model for those who buy goods online. The platform will be very, very technically clever, and it will split out the VAT and pay that over to HMRC in real time, and the vendor will only get the net of VAT price in his pocket. So interesting change to the VAT regime. No doubt we'll learn more on the 7th of November when the responses are published by HMRC. VAT groups so far have always been restricted to corporate entities, including LLPs. It will now be possible where these corporate groups are owned by individuals and partnerships for those individuals and partnerships to join a VAT group from April 2019, which at the very least will give rise to some economies of reporting VAT. Another area where the government is keen to combat the supplier disappearing down the road with customs VAT is in respect of certain construction services, and there's going to be a change to the VAT treatment with effect from October 2019, whereby the VAT will be accounted for not by the builder, but by the recipient of the services, who will effectively pay that VAT over as part of its own VAT return. There are also going to be changes to the treatment of vouchers after the 1st of January 2019, with the introduction of single-purpose vouchers. VAT historically has been accounted for not at the time the voucher is sold, but at the time the voucher is exchanged for goods and services. For single-purpose vouchers, where the VAT rate can be determined at the time the voucher is handed over to the purchaser, VAT will be accounted for at that stage, not when the voucher is encashed. Multi-purpose vouchers, which are basically vouchers where you can't determine the rate of VAT, will continue to have the VAT accounted for when the voucher is handed over and exchanged for goods. Making tax digital for VAT, very soon to be upon us, 1st of April 2019. There is a pilot open. Once you're in it, if you believe you're going to get some advantage by being an early adopter, you can't pull out. So think carefully. But as we know, it's becoming mandatory from the 1st of April 2019, although at that stage the obligations shouldn't be too onerous. But even so, it's being delayed to the 1st of October for various entities, trusts, groups, those users of the annual accounting scheme, not-for-profit, various public sector entities. So these are complicated or large entities that are getting effectively 6 months grace. Preparing for Brexit, as Mr. Hammond said yesterday, we're all going to get a deal for Brexit. So otherwise, he's going to stand up in the spring and give us another budget. So if that's not an incentive to find a solution to Brexit, I don't know what is. There are some things that businesses should be looking at now. There will be an introduction of postponed VAT accounting for imports, which will be very, very useful. It will aid cash flow for business. We will, as the UK, unilaterally introduce that. There is undoubtedly going to be a mad rush for authorised economic operator status to make sure that goods coming into the UK go through customs as easily as possible. So if you've got the opportunity to apply for it, I'd do it now, because it's going to be absolutely bonkers the closer we get to April. As you can see, there are various things that perhaps one should look at. Look at your group structure. Are you going to have delays somewhere in your supply chain as a result of goods crossing borders? Will you need to register elsewhere in the EU? So all those questions and more can be answered by looking at the BDO Brexit Hub. And a budget wouldn't be a budget without HMRC looking at avoidance enforcement and their powers. The first matter there is making directors jointly and severally liable for their company's unpaid tax liabilities. This has been subject of consultation and will come in from April 2020. The Chancellor and the Inland Revenue have both been very keen to stress that this is there to catch the naughty boys, those who will not pay their tax, not those unfortunate businesses which, due to circumstances, economic or otherwise, find themselves insolvent. So that's the first change on the insolvency front. The second is a move back to giving HMRC a preference in insolvencies. It's not a general preference for all liabilities owed to HMRC, only for those taxes such as PAYE, national insurance, subcontractors tax, VAT, where effectively the company is acting as agent for HMRC. So things like corporation tax will not have a preference in insolvency, but it's to try and make sure that tax paid on behalf of employees, etc., will find its way to the revenue and will be available to credit against people's tax records. From the 6th of April 2019, the tax assessment time limits are going to increase from 4 or 6 years to 12 years for income tax CGT and IHT on offshore assets. This is to give HMRC more time to carry out their investigations. So less certainty, I think, for taxpayers. There will be carve-outs. So, for example, where the automatic information exchange provisions are in place, and it was reasonable to expect HMRC to have issued an assessment, these enhanced limits will not apply. So, some respite for taxpayers, but I think it will be of little comfort. Profit fragmentation. HMRC seems very keen on fragmentation. This is to prevent traders and professionals from, and this is mainly SME type businesses, fragmenting their businesses such that part thereof is carried on offshore through offshore entities resident in tax jurisdictions with a lower rate of tax than the UK, or no tax at all. The counter to that will be that those profits will find their way back to being taxed in the UK system in the normal way. And finally, much announced by HMRC, HMRC will have the power to secure security deposits in respect of corporation tax and CIS deductions where it considers that tax is at risk of the money not being paid over by the taxpayer. That's been mooted for quite some time, and the budget confirmed that that will go live from 6th of April 2019. And that concludes our budget briefing. Hope you found it useful. Thank you for watching and listening, and if you haven't been able to hear or see all of it, there will